Our next guest is Dr. Peter Berk. I am so pleased that he is here with us. Hello, Peter.
Hello, John, Margie, everyone out there. Happy Saturday.
It is a happy Saturday, and I understand in Buffalo, New York, they are under 18 feet of snow.
And counting.
Lake effect, Margie added from the back.
Yes.
Well, that's one reason I want a stopwatch here. Here we go. That's one reason I don't want to live in Buffalo, New York.
Or as my friend says, the People's Republic of New York.
Yes, there's that as well. Peter, you've got some new products that you have added at Reliant Mortgage, and they seem to be almost ideal for real estate investors. Could we go through a few of these?
Correct. Second mortgages for investment property.
Well, that's exciting. Let's do this. I'm going to share a screen here, and I'm going to share sound as well. And hopefully, and I've got to move this because it'll leave there we go. Now we're talking. Let's talk about home equity, HELOCs, home equity loans, and second mortgages for real estate investors. And the first thing you and I had talked about on this is that home equity lines of credit and home equity loans are growing dramatically right now in popularity. Why is that?
Well, there's equity in these properties that we've got. And for a number of reasons, I think homeowners, investors are reluctant to refinance that great first mortgage that they got last year and the year before that. But they need to tap into some equity. And this is a great alternative. You're able to keep that first mortgage intact and put a second mortgage behind that one.
I was surprised when you told me that the Fed is saying that estimated home equity in the U.S. now is at $20 trillion.
Yeah.
That's a lot of money.
Yes, it is.
Have you ever written out the number 20 trillion?
I wouldn't know where to start.
Well, let's put a $sign, 20, and then lots of zeros.
Yeah.
So what is the difference, Peter, between a home equity loan, a regular home equity loan, versus a HELOC or a home equity line of credit?
That's a great question. A line of credit is that you've got you're approved up to a certain amount, just like a MasterCard or a Visa, where you're approved up to a spending limit, and you can then draw against it, typically from a checkbook that you're issued. You can pay the interest, or you can pay the interest in principal during the draw period. You can have a zero balance, or you can keep a balance outstanding. It's just like a revolving line of credit that's secured by real estate is a home equity line of credit. A home equity loan is, using terminology which I'm somewhat reluctant to use, it's a closed-end mortgage, which means if you're looking for a home equity loan of $100,000 at closing, you're advanced $100,000 that you can walk away from the closing with, and then you receive a monthly, you receive a coupon each month where you have to pay back a portion of principal and interest over the next 30, even 40 years.
So I would call that a home equity loan in that sense is a lot more like a traditional mortgage.
In a second mortgage position.
Absolutely. Right. All right. Very interesting. Let's see what we've got here. Why do people, well, you already said this, but people these products are attractive because people use their available home equity. They can pay off expensive debt or do other things, but they get to keep that first mortgage in place. And this is ideal for somebody who may have acquired a property a couple of years ago and got a great low interest rate, or maybe they refinanced just last year, but that can save them a lot of money, right?
Correct. Keeping that first mortgage intact and not refinancing it. You may be saving money by not refinancing the first and doing it, but segregating, keeping the first intact and obtaining a second. You have to pencil it out and see which way works best for you.
Well, that's one of the things people love about dealing with Peter Berk at Reliant Mortgage. I was surprised when you told me that there's an estimated, and you said it's estimated because nobody really knows, cumulative total of $600 billion in non-mortgage debt.
Right.
Why would people be carrying credit card debt or car loans when they've got all this equity in their real estate?
It may be an opportunity to look at it on paper and decide which way works best for you in your situation of consolidating it.
Peter, I am proud to tell you, Margie and I have been married 46 years on our way to forever together, and we have never had debt for an automobile.
God bless you guys.
We buy them cheap and run them till the wheels fall off.
You're a minority, I believe. I think I saw somewhere that 10-year car loans may be coming up.
Why not get a 30-year fixed on a car?
Yeah.
All right. Well, let's see here. Oh, this is interesting because you had shared with me these 7 common uses for home equity lines, and there are several here I never thought of. You want to run through these?
Sure. Well, obvious, the first one, you want to finish your basement, put in a new kitchen, consider using a home equity line of credit for home improvement.
By the way, we are redoing our kitchen right now, and it is staggeringly expensive.
I know.
Yikes. But home improvements, that makes sense. And a lot of people are choosing to not move and stay where they are. One reason is they've got a great first mortgage. So,
yeah.
Okay.
Yeah, exactly.
Number 2,
credit cards or other higher interest debt. You're paying 18, 19, 20% on a credit card debt, and it may make sense to exchange that with a home equity line of credit and reduce your overall debt payments.
and the other thing I would mention here, and I don't want to get into this discussion today, but there may be, depending on how this is structured and your other debt, you may be able to deduct some or all of the interest that's paid on a debt that is secured by your home. And people should talk with their tax advisors about that, right?
Absolutely.
Very good.
Absolutely. Have a nice discussion.
Good. Number 3, why would you pay for education when President Biden is trying to pay for your education for you?
Yeah, exactly. Well, I don't know if he's having too much luck on that one. But,
well, we'll see what happens. If I had worked real hard and paid my way through school, I'd be sort of hacked off at somebody who was getting $20,000. Fund a vacation. What about a cruise?
yes, you can fund a cruise in January.
So people on January 28th, they could fly down to Miami, or Margie and I are driving, and they can find out more at expocruise.com. See how I cleverly worked in a little commercial for the cruise?
Right.
There. What about medical expenses? I am stunned at the cost of medical expenses these days. And I suppose that might be a reasonable use for a home equity loan.
Yeah, I mean, I sympathize with anyone in this situation, but it is an option. And maybe if there's some procedures that you're interested in doing that aren't covered by insurance, that could be a great use for it, or the difference between what your insurance covers. Again, a horrible situation to be in.
Yeah.
And, what you're able to pay for out of pocket.
Peter, the next two I had not even thought of, and I'm going to let you speak to them because I just want to make sure that these things are legitimate and that nobody's doing something here, or that we're suggesting they do something that might be that some lender might be unhappy with.
You can source your down payment closing costs for buying a second home at the beach or mountains, a rental property, or even another primary if you're planning on relocating, from any source that is secured against real estate.
And that's it, as long as it's disclosed, that's all okay?
Very common, makes a lot of sense, especially if you're buying a rental property. There is nothing illegal, immoral, unethical about buying a second home, rental property, or a new primary residence and using the funds from a secured line of credit.
Peter, I want to come back to that in a future visit, because I really think we should flesh this out, especially number 7, which seemed it's a great idea.
Absolutely.
And yeah, we'll circle back. You told us last week about a new product you have, and tell us what you found out about it.
Well, actually, there's one error on your worksheet, but it's actually a good error. You can go up to bullet point number 4, but let's start in order. These are second mortgages for rental properties. And again, the same advantage. You refinanced that rental property last year through me or someone else at 3.5%, 30-year fixed rate mortgage. It would be a shame if you wanted to get equity out of that property and refinanced and eliminated that great first mortgage. So here's an alternative on rental property to get some of that equity, up to a generous 85% combined loan to value.
Wow, that's pretty good. Well, you're talking 40 years potentially, and 85% LTV.
Yeah, combined loan to value. So explaining that simply, if you've got a $100,000 property and you've got a $35,000 current balance on your first mortgage, you could get a second for $50,000. 50 plus 35 is 85,000, which is 85% of the value. That's just an example, but up to 85% combined loan to value.
There are people listening right now and watching right now who have that exact situation. And I'll bet they've been scratching their head saying, how do I get at some of this equity that really has been building up? But I don't want to disturb my first mortgage because I got a great rate on it. You've got the product for them.
Yeah, and there's a bullet point I didn't put on here, but because I want to talk about it. But there are a number of ways to qualify. There's the traditional way with your pay stubs, tax returns. That's known as a full doc. You're using income. Believe it or not, you can use this as a discover loan, a second mortgage.
Debt service coverage ratio. Isn't that interesting?
Yes, where the property stands alone. You're not providing any income documentation or pay stubs. So if you've got a property with a lot of equity with a first mortgage on it, and you don't want to use your income, or your income isn't sufficient, you could do this as a Discover loan.
Very interesting. And Reliant Mortgage and Peter Berk, you guys have pioneered these Discover products, and they really have been very well received. I would encourage anybody who's heard what we just talked about and said, hey, I want to know more about this, pick up the phone, call Peter right now, 678-557-9759. Peter, are you available this weekend if somebody just had a question about this or wanted to sort of put their heads together with yours and let's see what might come of it?
Absolutely.
Fantastic. Once again, 678-557-9759. The easiest number in the world to remember. Peter Berk, thank you and have a fabulous weekend.
You too, everybody. Have a great one. Have a safe Thanksgiving.
Happy Thanksgiving. We'll talk.
Yeah.